Hello students, welcome to EPG Pathshala. I am Dr. Sanjeet from Government College Nadon, Himachal Pradesh. Today we are going to talk on module LIFO and FIFO methods of valuation of inventory from paper Accounting and Financial Analysis. After studying this module, the students may able to understand the basis of inventory valuation, classification of methods of inventory valuation, understand the specific identification cost method, understand the meaning and feature of FIFO method, explain the meaning and features of LIFO method, discuss weighted average price method, and compare different methods of valuation of inventory. Inventory is one of the most important assets posed by a business. Preparation of accurate income statement and balance sheet of a concern largely depends on correct valuation of its inventory. There are different methods for assigning historical cost to inventory and goods sold. Choosing the correct inventory valuation method depends largely on the characteristics and the needs of the business. For understanding the valuation of inventories, it is necessary to get the knowledge of basis of valuation of inventories. And inventories should be valued at the lowest of cost or net realizable value. It means cost of inventory or net realizable value, whichever is less, that value will be taken as a value of inventory. It is clear from this picture also that inventory should be valued at the lowest of cost or net realizable value. And cost of inventories include cost of purchase, cost of conversion, other costs. Now, basis of valuation of inventory. Inventory is valued on the basis of cost or net realizable value, whichever is less. Cost of inventory include cost of purchase, cost of conversion, and other costs incurred for bringing the inventories to the present location and condition. Whereas net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. There are different methods of valuation of inventories. So it is necessary to get the knowledge of methods of valuation of inventories so that correct valuation of inventories can be done. It is clear from the picture or figure that methods of valuation of inventories can be divided into two parts. And these methods are based upon the fact that inventory is orderly interchangeable or not interchangeable. If it is interchangeable, then specific identification method can be applied. But if it is not interchangeable, then FIFO, LIFO or weighted average method can be applied. FIFO mean first in, first out method. LIFO mean last in, first out method. And weighted average method gives weight to price with the help of quantities. So these are the methods which are available for the valuation of inventories. Specific identification method. Specific identification method is the simplest method used for valuation of inventories. Specific identification method is suitable in situations where it is possible to physically separate different purchases and each item sold and each item remaining in inventory can be identified. The cost of specific items that are sold during a period is included for calculating the cost of goods sold for that period. Further, the cost of specific items remaining at the end of a period is included for calculating inventory at the end of that period. This method can be used in businesses such as car dealership, jewelers, art galleries. This method can applied only when a company knows the cost of every individual item that is sold. The quantity of inventory is limited, each inventory item is unique. Now, suitability of this method. This method is suitable when the material or goods have been purchased for a specific job or customer, or when a company is handling a small number of items. Specific identification method can be better understood by the help of this example. The records of seats are given, and according to these records, material is received on 1st January, 800 units for job number 2 at the rate of 10 per unit, and January 3 it is received 600 units for job number 3 at the rate of 11 per unit, and January 18 received 400 units for job number 4 at the rate of 12 per unit. During January 2015, the issues of material were: on January 10, it issued 400 units to job 2, January 14 issued 200 units to job 3, January 19 issued 400 units to job 2, and January 20 it issued 400 units to job number 4. Store ledger account is made, and according to this store ledger account, there were 2 receipts on January 2 and 3 for job number 2 and 3, quantity 800 and 600, rate 10 and 11, and these are shown in the balance also. There are 1400 units and amount is 14,600. And when we have to make issue on January 10 for job number 2, then according to specific identification method, we have taken the material which is specifically purchased for job number 2, and the rate of this material was rupees 10. So material which is issued for job number 2 is issued at the rate of 10. And when we have to make an issue of 200 units for job number 3, this material is issued at the rate of 11, the rate at which this material was received specifically for job number 3. So it makes clear that in specific identification method, materials are issued according to specific jobs and they can be separated. It is important to study the advantage and disadvantage of specific identification number. In specific identification method, actual costs are matched against revenues. An important advantage of specific identification method that in this method, flow of cost is corresponding to the physical flow of inventory. Disadvantage of this method is inappropriate in most cases due to practical considerations, such as manipulation of income. The biggest limitation of this method is that it opens doors to income manipulation, and the net income can be easily manipulated under this method. In case of number of inventory items, in case of a manufacturing concern have number of inventory items, then this method will fail, as it is impossible to identify the cost of each individual item of inventory. First in, first out method. According to this method, inventory is used or sold in the order they have been purchased, and older inventory is issued first. It is based on the principle that cost should be charged to revenue in the order in which these have been incurred. Simply, goods or material received first are issued first. First come, first serve is the basis of issuing goods or material. FIFO method can be cleared with the help of example, and the purchases of material during the month of January, there were on 1st January opening balance of material was 1000 units at the rate of 2. On 6th January it received from vendor 400 units at the rate of 3 on January 11. It received from vendor 300 units at the rate of 2 on 20th January. It received 600 units at the rate of 3 on 26th January. It received 800 units at the rate of 2. Then issues were made. Material was issued on 1st January 400 units, 10th January 800 units, 18th January 200 units. FIFO method is presented with the help of store ledger account, and it is clear from this account that when we have to make an issue on 10th January of 800 units, then preference was given to the material which was received first, which was first in, which was received first, and the material which was received later was issued later on. In a similar manner, when we have to make an issue of 200 units, these were issued at the rate of 3 per unit, and preference was given to the material which is received first. So this method shows that the material which is received first will be issued first. This works on the principle of first come and first serve basis, and the material which is received first will be used first. Features of first in first out method. Now, assumption of this method. Under this method, it is assumed the material or goods that are sold or used first are those are bought first, or in other words, the first inventory item that arrives is the first inventory item to go out, or the goods that arrive first are the first to be used. In this method, value of inventory in hand will always be the most recently purchased items and valued at most recent or current prices. The cost of goods purchased first is the cost of goods sold first. This means the cost of goods sold is taken on older prices. The FIFO method is suitable in following circumstances: when nature of material or goods are perishable, purchases are not made frequently, when the prices in market show a declining trend, in case inventory items are bulky or slow moving or costly. The impact of fluctuations in prices, the impact can be divided into two parts. In periods of rising prices, in FIFO method, inventory will be valued at higher prices, cost of goods sold will be relatively deflated, profits will be inflated, it will increase in liability for payment of taxes. Whereas in case of periods of falling prices, in FIFO method, inventory will be valued at lower prices, resulting in deflating the profits, reducing the income tax liabilities. Now, effect of this method on balance sheet and income statement. In normal circumstances, FIFO method balance sheet shows a more correct and fair picture, since the inventories at the end is valued at the recent or current market price. But in case of fluctuations in prices, there can be two situations. In periods of falling prices, method gives a more correct, fair, meaningful and clear balance sheet, whereas it provides a less realistic income statement. In case of periods of rising prices, FIFO method gives a less realistic, fair and meaningful balance sheet, and a more elastic income statement. Now, advantages of FIFO method. FIFO method is simple to understand and easy to apply, and this method is a realistic method. In this method, inventories are taken at current prices. So this method is also acceptable by tax authorities and Indian accounting standards. This method reduces the risk and there will be no unrealized profits under this method. So the advantages of this method are shown in this figure, makes clear that the FIFO method is very much effective method as it is simple, easy, realistic, and show the inventory at current prices. It is acceptable by tax authorities and it reduces the risk. Further, there will be no unrealized profits under this method. So this method is very much effective method. In this picture or figure, disadvantages or limitations of this method are given. According to limitations of this method, we can see the cost of goods sold are not shown on recent prices, and this method creates problems in case of price fluctuations. There will be possibility of clerical errors in this method. It is difficult to compare or make comparison between different jobs when this method is adopted, and it will result in higher tax liabilities. When this method is adopted, business face higher tax liabilities. So these are the limitations of this method which is faced by an organization. Last in, first out method. Under last in, first out method, the newest inventory is recorded as sold or used first. According to this method, the last items of materials or goods purchased are the first to be issued or sold. The items which are purchased last will be issued first under this method. LIFO method is also clarified with the help of this example. The purchases of material during the month of January 2015 are given. On January 1st, 2000, opening balance of 1000 units at the rate of 2. On 6th January, 400 units at the rate of 3. On January 11, 300 units at the rate of 4. January 20, 600 units at the rate of 3. And January 26th, 800 units at the rate of 2 are received by the firm. And it has made issues. It issued 400 units on 5th January, 800 units on 10th January, and 200 units at 18th January. LIFO method is cleared with the help of stored ledger account. This account reveals that on 1st January 2015, there was 1000 units at the rate of 2. On January 5th, an issue of 400 units were made at the rate of 2, and there was 600 units which were remaining in the stock. On 6th January, additional 400 units were purchased at the rate of 3, and now in stock there was 1000 units in which 600 units were at the rate of 2 and 400 units at the rate of 3. Now, when we have to make a issue on 10th January, the issue was of 800 units. We have to make an issue of 800 units. The preference was given to the units which are received last, that is 400 units at the rate of 3. It means in LIFO method, the units which are received lastly are issued firstly. Which comes last goes first. In similar manner, when on 18th January we have to make an issue of 200 units, the preference was given to 300 units at the rate of 4. It means the units which were received lastly are issued firstly. So this makes clear that under LIFO method, the material or goods which are received last are consumed first or sold first. What are the features of LIFO method? LIFO method is based on the principle that the last inventory goods received will be the first inventory goods used. Arrive last are the first to be used. Value of inventory in LIFO method. When the LIFO method is used, the inventory at the end of the period or year consists of goods placed in inventory at the beginning of the year. Thus, under this method, inventory valued at the earliest cost. In circumstances of fluctuation in prices, there can be two situations. In periods of rising prices, LIFO will result in lowest inventory, highest cost of goods sold, lowest income, and reduction in liability for payment of taxes. In period of falling prices, LIFO method will result in inventory will be valued at higher prices, resulting increase in profit, increasing the income tax liabilities. Effect of LIFO method on balance sheet and income statement. These effects can be divided into two parts. In normal circumstances, when this method is used, balance sheet shows a distorted picture since the inventory at the end is shown at old cost. But in case of fluctuation in prices, there can be two situations. In periods of rising prices, LIFO method gives more meaningful, true and fair view of balance sheet and a less realistic income statement. Whereas in periods of falling prices, LIFO method gives a less meaningful balance sheet but more realistic income statement. Now, advantages of LIFO method. LIFO method is very important method and it is suitable for non-perishable type materials. In this method, valuation of issues is done at current prices. There will be no unrealized profits or losses under this method. Further, it lower business tax liability. If this method is used, the tax liability of business is low as compared to FIFO method. So this method is very good method for businesses. Disadvantages of LIFO method are shown in this figure. This method is not appropriate for some businesses. It is not good for all businesses. You cannot say that this method is best method and it is applied for all types of businesses. So it is not suitable for some types of businesses. Further, it may create obsolete inventory, and IFRS prohibits the use of LIFO method. International Financial Reporting Standards does not recommend to use the LIFO method. It is the biggest limitation of LIFO method, that is not recommended by International Financial Reporting Standards. The difference between FIFO and LIFO method is shown in this table. Now, assumption, the first point of difference is assumption, and FIFO is based upon the assumption that goods or material which is received first, issued first. Whereas LIFO is based upon assumption the goods or material which is received last, issued first. Now, second point of difference is valuation of cost of goods sold. Cost of goods sold does not reflect current prices. In case of FIFO, cost of goods sold does not reflect current prices, whereas in case of LIFO, these represent current prices. Value of inventory. Closing inventory reflect current market prices in FIFO method, whereas closing inventory does not reflect current prices in LIFO method. Now, effect on profit and tax liability. During the periods of falling prices, FIFO method provides lower income, reducing tax liability, whereas during the rising prices, higher income is reported under this method and it increases the tax liability. Whereas in LIFO method, during the periods of falling prices, higher income is reported and it increases the tax liability. Whereas during the periods of rising prices, lower income is reported under this method and it reduces the tax liability. Effect on balance sheet. Balance sheet shows a more correct picture since the closing inventories are valued near to the current market price under FIFO method. Whereas balance sheet shows a distorted picture in LIFO method since the closing inventory is shown at old cost. Weighted average price method. Weighted average price method is based on the assumption that material or goods which are purchased are combined into a common bin. After that, they lose their separate identity. The inventory does not consist of specific batch of goods. The inventory is thus priced on the basis of weighted average prices. These are weighted according to quantity purchased at each price. Weighted average cost is calculated given as below in the formula. The average cost is value of inventory at the beginning of the year plus purchases during the year divided by number of units at the beginning of the year plus number of units purchased during the year. Now, according to this formula, weighted average price is based upon the assumption that when material is purchased, it loses its separate identity. So we add value of inventory at the beginning and purchases made during the year and divide it with the number of units at the beginning of the year plus number of units purchased during the year. Weighted average price method is clarified with the help of the formula. Example, the following are the purchases of material during the month of January 2015. On 1st January 2011, the opening balance of 1000 unit at the rate of 2. January 6, received from vendor 400 units at the rate of 3. January 11, received from vendor 300 units at the rate of 2. And issues of material were as follows: January 5, 400 units, January 10, 800 units, 18th January, 200 units. And under this method, store ledger account is prepared. It shows that on 1st January, there was a balance of 1000 units. And on January 5th, 400 units were issued. The balance was 600 units. And on 6th January, 400 additional units were purchased at the rate of 3. Total balance was 1000 units and the cost was 2400. As in this method, the purchases lose their identity and they are put into common bin. So by the number of units are added, 600 plus 400 is equal to 1000, and the cost become 1200 plus 800, 1200 plus 1200, 2400. On January 10th, 800 units were issued, and for issuing the formula was used: number of value of material at the beginning plus purchases divided by number of units at the beginning plus number of units purchased, and we have divided 2400 by 1000 and get the rate of 2.4 per unit. So it shows that in this method, in weighted average method, the units and the value or cost is combined. They lose their separate identity. Advantages of weighted average price method. This method is logical method. It minimizes fluctuations and ease the pricing process, smooths out fluctuation in profits. In this method, computerized system can be applied. And this method is also acceptable by tax authorities and Indian accounting standards, and it is a popular method which is used in organizations. This figure makes clear that this method is logical and popular method which is used by organizations. This figure makes clear what are the limitations of the weighted average method. It shows that weighted average method does not reflect actual price. In this method, rounding off is required, which creates problem. And this method is not a suitable method in the periods of rising prices. So these are the limitations of this method, and these are cleared with this picture. Comparison of FIFO and weighted average price method is shown with the help of the table. Table shows two situations. Now, first situation, if prices are showing rising trend, and second situation, if prices are showing falling trend. In first situation, when prices are showing rising trend, the value of inventory at the end, net income, valuation of assets are higher in FIFO method as compared to weighted average price method. Whereas if prices are showing falling trend, the value of inventory, net income, valuation of assets are lower as in FIFO method as compared to weighted average price method. Now, which method is best? Selection of best method is a big question, and there are several methods to value and cost inventory. Inventories represent important current asset of a concern. Selection of the right inventory valuation method depends on the specific characteristics and objectives of the valuation. Further, the recommendations of Indian Accounting Standard and International Financial Reporting Standards about the selection of valuation method should also be considered. Now, recommendations from Accounting Standard 2. This standard provides FIFO or weighted average method for computing the cost of inventories. It has recommended the use of specific identification method only in case of goods or services which are meant for specific projects. Recommendations from International Financial Reporting Standards, and according to International Financial Reporting Standards, entities are permitted to employ one of the three cost formula when reporting inventory expenses. These methods are specific identification, FIFO, and weighted average cost method. So, it can be concluded that generally FIFO and weighted average method are popular and recommended methods. Thank you.